All right, let's go. So, hello everyone. Good afternoon or evening, depending on where you're located. My name is Natasha Mcpherson, and I'm the owner of MedicareRocks.com and McPhersonInsurance.us. Before we get started, I just want to take this moment and thank you for being here. I commend you for taking steps to improve your future and of the future generations in your family to come. Today we'll teach you how to invest in real estate, how you can use life insurance to supplement income right now, how to protect your estate from everything that could go wrong, and the importance of having a financial advisor to overview your overall plan in retirement. Self-funding and hoping for the best is not a plan. Real estate, life insurance, estate planning, and financial planning all have an integral role in creating generational wealth and leaving a lasting legacy. And just like anything else, a large part of getting what you want and where you want to be is having a knowledgeable team to help you, guide you, and support you. Today I'm happy to have real estate investment advisor Charlie Brown, estate attorney Justin Hedemark, and president of Hall Wealth Management, Andrei Hall, here with me to help you. So let's get started. We have a lot to cover today. Right now, I'm really excited to pass things over to Charlie Brown, also known as the fiercest negotiator in real estate, who's a part of my professional network of knowledge. Charlie, how are you?
Hi, Natasha. Thank you. What an introduction. So I like that. Yeah, thank you so much. It's a great opportunity. Thank you and Andrei for allowing the opportunity to present here. I'm going to share my screen and start the presentation here. Give me just one moment. All right, so creating generational wealth through real estate. Again, wanted to thank everyone for being here and carving out some time to listen to this presentation. So who am I? Let's start there. My name is Charlie Brown, so we'll just get that joke out of the way. I am a San Francisco-based real estate investment advisor and a licensed California realtor. I'm also a member of the National Commercial Real Estate Association as an advisor there, and I'm certified as a real estate investment planning specialist. So my contact information is on there. There'll be another opportunity to grab that as well. So we'll jump right into what we're going to learn today. So what is generational wealth? Well, so just basically an accumulation of assets that you've collected over the years that could come from a lot of different sources. So most people think of, generational wealth and assets as stock market investments, real estate investments. Perhaps you've built a business over the course of your life. And life insurance policies are part of that plan as well. And what we want to do is make sure that those assets are protected. So Justin Hedemark is going to talk a little bit more later about protecting your assets, creating an estate plan. But one of the things that I wanted to bring up that's near and dear to my heart is making sure that you teach your children about your personal finance and how to be a part of that generational wealth building. So we're going to cover some different strategies to do that. And realistically, real estate is one of the greatest paths to generational wealth. That can be done through either residential or commercial real estate. And there's a number of different ways to build that wealth in residential or commercial via single family homes, small multifamily homes, large multifamily, investments. And the real question is, how much time do you have to invest? If you're going to be more active or versus passive in this, and we'll come to some more of your goals later on in the presentation. So the three different kind of real estate investments, to take a look at are core, value add versus opportunistic. And you can get turnkey rentals, which tend to lean towards a little bit more passive investment. They're a little bit easier barrier to entry, not as active a role. You could do fix and flip or real estate owned or foreclosure. Those are typically have a little bit more active involvement. And then we have something we call the BRRRR investments, where you buy, rehab, rent, refinance, and repeat. And it's a great way to kind of, just build your portfolio one at a time, and really kind of have not only an active role in building that real estate portfolio, but also once it's refinanced, you're on the passive side of things. This is just a little, bubble of all, not all, but quite a few of the different ways to make money in real estate from not only an active role, but also passive. So I'm just going to briefly talk a little bit about active investing, pros and cons. You essentially, think of active investing as almost you're trading time for money. The short-term returns could be a lot higher. You're definitely a lot more in control of this process, but the time invested is pretty heavy. You also have more volatile swings in returns when it comes to this. So your margin of error is really dictated by where you are in the market. For instance, if you're looking at a fix and flip and the market turns before your fix and flip is finished, you could be shaving off your profits there. Most people want to look at passive investing, right? So where you're investing money in the deal once, you have less day-to-day involvement, and you're getting those monthly checks, that provide that cash flow on a monthly basis. So typically you have less control of the returns, and sometimes you're pooling money with other people. But over the long run, this is probably the best method of investing over the long run. So why real estate? Why passive real estate? Well, it offers, generating cash flow. You have that monthly check that's coming in. You're also taking advantage of the appreciation of the real estate. You're also taking advantage of depreciation and lots of other tax advantages of real estate, which Andrei will probably get into a little bit more in the presentation. And then my favorite is leverage. Real estate's one of the only investments where the bank is actually loaning you 80% of the money in some cases more, to purchase 100% of the asset that you can enjoy that appreciation on. So you need to develop a plan. What we would do is we would sit down and talk about what your timeline is, what your level of involvement is, how big of a risk profile you want to take, and then where you're funding those investment from. How are you going to fund the investments? You could use W-2 income. You could use your individual retirement accounts, and those retirement accounts could be self-directed. You could use, life insurance policies. You could use other portions of other real estate that you have, and we'll talk a little bit more about how to do that. And you can partner with people, and you could use other people's money as well. So I'm going to go into a little bit on returns on investment, but I don't want to stick too much into this. I just want to show you an opportunity that works for building, generational wealth and growing that investment over time. So these are three types of returns on investment. Cap rate, I'm sure you've heard of, cash on cash return, and return on equity. So a little bit about each. Cap rate, just to kind of keep things simple, where net operating income, divided by the market value equals the cap rate. So if you have $1 million property that yields you $100,000 in net operating income, you have a 10% cap rate. And that's a good way to value real estate or see whether or not it's something that you want to move forward on. In general, you want to purchase real estate at the higher cap rate, and you want to sell real estate at the lower cap rate. Cash on cash return. Again, this is a very, very simple way to figure out returns on investment. If your annual pre-tax cash flow divided by your total cash invested, very, very simple return. So if you've invested $300,000 into a property and it returns $100,000 at the end of the year, you have a 33% cash on cash return. I'm not saying you're going to get that cash on cash return. It's certainly very nice. I'm just trying to keep the numbers simple. So using that same strategy, the return on equity is where you really make the difference. So just to keep things simple, your shareholder equity in that same investment would be $300,000. So your initial return on equity is actually 33%. Again, $100,000 return, your initial down payment of $300,000, 33% return. Well, there's a time value for money that goes away over time. Over the course of 10 years, you're going to appreciate, your real estate's going to appreciate, and your principal is going to pay down. You're also going to increase your rents over that period of time. So after a 10-year period, your rents increases to the tune of Maybe you have a net operating income of $121,900, and you've increased your equity in the building by just under $1.1 million. So your actual return on equity lowers from 33%. That goes away. From 33% when you initially started, it actually lowers to 11.2%. Okay, which would you prefer? A 33% return or an 11.2% return? I think we'd all prefer the 33% return. So how do we make that money last? How do we grow that money? So here's your existing investment property, all your existing numbers here. What we're going to do is we're going to sell that building at roughly, $1.6 million. And then after all your closing costs go out, you're going to be left with just under $1 million to invest. You're going to 1031 exchange that money, and you can do this into 1 property, 2 properties, 3 properties, 5 properties. For the simplicity, I've just basically taken this and divided it into 3. And now you're going to take that $981,000. You're going to put a down payment of $327 down on 3 new properties, and you've increased your return on equity back up to 30.6%. So that's the simple way to look at your return on equity. It's a very, very valuable calculation to look at. So where do I invest? The old adage, location, location, location. Well, I'm here to tell you that that's really not exactly true. There's much more involved in that. I prefer to figure out a strategy. I prefer to figure out the economics of the location that I'm looking at. And I certainly want to surround myself with a team that can advise me and help me purchase the right property. We want to look at what your plan is, and we want to look in where different cities are in their market cycle. Every city in the United States is going to be going through one of these 4 market cycles. Recovery period. There's always, after a recovery period, an expansion period. Hyper supply. A lot of places in the United States right now are seeing this hyper supply phase, and then eventually something's going to move into a recession, right? So just to kind of take a look at the multifamily investments right now. This graph comes from Integra Realty Resources. It's a great resource for you to go in on their website and look at what cities are in what market cycle at the moment. So right now we're looking at Dayton, Ohio, New Orleans in the recovery period. Atlanta, Georgia, Baltimore, Fort Worth, Dallas are all in the expansion period, right? So I would want to go into these cities are in the recovery and expansion period and look for really solid opportunities in these 2. Once they're in the hyper supply market cycle, it's too late. The ship has sailed. Now it's time to start thinking about selling before we get into this recession period. So that's one of the things that we talk about when we sit down and develop a plan for you. So developing a strategy is key. You have to invest in your education and work to build your team of real estate professionals, insurance professionals, estate planning professionals, all of which you have on this call here. Network. I can't stress that enough. Talk to people at parties, go to social events. There's online resources for you. And then look for opportunities. Utilize your real estate agent. Again, LoopNet is a great resource. Networking is a great resource. And then what's important is you develop a system for underwriting deals, okay? You have to make it so it's a system. You have to have spreadsheets and checklists and automation, because you're going to be looking at, a deal comes in. You have to have a formula for figuring out whether or not this is a good deal based on your plan. And you have to make offers. Make offers. I cannot stress that enough. You will not get a deal unless you make an offer. And the reality is, the more opportunity, the more offers you make, the more opportunities that you have. So that's the end of my presentation. I really wanted to thank everyone. My contact information is there, and would love to speak with you on how to get started. And Natasha, thanks a lot for letting me present.
Hi, Charlie. It's always good to hear from you. Let me get my screen loaded up here. Show the screen.
Well, thank you so much, Charlie. Wow. Thank you for a wonderful, in-depth explanation of building wealth through real estate. It's always a pleasure to have you and Justin and Andrei. You guys are a part of my network and my team of knowledge, so thank you so much. It's always a pleasure. If you missed the beginning, my name is Natasha Mcpherson. I'm the owner of MedicareRocks.com and McPhersonInsurance.us. Both based in Orange County, home of Gwen Stefani, the original Housewives, and Orange Groves. Very nice things. I've experienced firsthand the power of insurance, or should I say lack thereof, when I was in an accident. I was young, the policy was through my job, I didn't understand it, I really didn't think it mattered at the time, but knowing what I know now, if I just would have talked to someone or did more research, I could have been in a much better position during such a hard time with the help of a better policy. Today I hope I can inspire you to take care of yourself and your family instead of having to struggle through a hardship and wish you would have taken proper steps earlier in your life. So, why is life insurance important? As we get older, we get married or into partnerships, we start families, we build businesses. We put a lot of emphasis on working hard to protect those unions and businesses. We do have a nice life, but mostly leave the ones we love with a comfortable life after we're gone, right? We'll come to find as time rolls on, inflation rises, and job demands get even higher. A normal 9 to 5, I think they're called like 8 a.m. to 7 p.m. now, will not always produce what you have in mind for your family financially, or the time you always imagine you get to spend with them. This realization of the current and future pressures also have heart attacks, anxiety, and depression up. Life starts leaving you, and before you know it, it's all over. Unfortunately, unexpectedly or expectedly. Most equate life insurance with death, and while that's true, it can also be a powerful financial planning tool while you're alive. And when it's all said and really done, life insurance will be there to benefit your family as well. So, what we'll cover today: what is life insurance? Types of life insurance. How does life insurance accumulate cash? What can life insurance be used for? How can I use life insurance now? How can I use life insurance to buy a house? How to protect those assets with life insurance? How will life insurance benefit my loved ones after I die? And we'll sprinkle in long-term care in a little bit of all of that. So what is life insurance? Life insurance is an important part of your overall financial planning. I want to point out, it should not be seen as a product. It should be a part of the plan. So I'm going to say that again. Life insurance is a part of the plan. Just in case some individuals are unclear how it works, life insurance is a contract between the insured and the life insurance company. Once the insured passes away, the life insurance company is designed to pay out a death benefit when the insured passes away. I want to interject here and say that there's many companies that offer life insurance. It's important to work with someone who knows about each company, how that company operates, and does a deep dive into which life insurance product is best for you. Usually we hear this a lot, oh, my friend has this, I want this. That's not how it works. What is good for your friend may not be the best for you. My office has over 30 years of experience in it and knowledge to not only fit you in the best life insurance for you, but to choose a company that's easy to work with and great at providing customer service. This is very imperative when you're dealing with life insurance. But while we're on the topic of passing away, it's important to choose your beneficiaries wisely to make sure the right individuals are eligible to receive proceeds from your policy. I was in a meeting with some other financial professionals, actually a class, a couple weeks ago. One told a story about a client of his who died. The beneficiary on the policy happened to become a little bit of the wild child in the family and was never removed off the policy. He ended up marrying a girl from a different country on a whim, and now all the family's wealth belongs to her and is floating around Europe. There's a lot more to the story, but that's the bottom line. So beneficiary choices are so important, and so are estate decisions. And planning is very important to avoid costly mistakes like this. So there's different ways to do it, which Justin Head and Mark will get into in a bit. But now let's get into living benefits and how life insurance can protect assets. But did you know Walt Disney is a loan from the cash value of his personal life insurance to finance his first theme park? Stanford University used the death proceeds of its founder to weather a period of financial difficulty. The owner of McDonald's used loans from his 2 cash value life insurance policies and bank loans to cover the salaries of key employees in early years. So, types of life insurance and how they accumulate cash. Term life. This one's probably Charlie's favorite. Secures financial protection for a specified period of time and is the least expensive policy that you can buy. It provides a death benefit for either 10, 15, 20, or 30 years. It's a low-cost option given its short-term nature with lower premiums compared to permanent policies. But after the term, the policy will stop and the client will have to apply again and pay a higher premium. It's typically purchased to cover temporary needs such as paying off a mortgage or to replace income needed by loved ones. But it's also important to know that there is no cash value in term life insurance. Permanent life, which is an umbrella term for life insurance policies that don't expire, such as whole life. Permanent policies help ensure financial protection for your whole life and may also provide benefits during your life. They offer the ability to accumulate cash and tax-deferred supplemental income for retirement, emergencies, college tuition, and much more, which we'll get into later. It can come with an optional long-term care protection through a long-term care rider. There are many options available that can impact the cash value, which you'll see in the next two. Universal life. It's a permanent life insurance with a savings account element and lower premiums. Cool thing about universal life, which a lot of people like, is to keep universal life policies in effect, it will cost what the minimum premium payment is per month, which consists of several cost factors related to the policy, like charges for mortality, policy administration, and some other charges. The cost depends on the insured's age, insurability, and the insured risk amount. If you pay in excess of what the premium is, it will accumulate within the cash value of the policy. If there's enough in the cash value, you can choose to use it to pay the premium each month. The cash value earns interest based on the current market or minimum interest rate, whichever is greater. Beneficiaries only receive the death benefit, not the excess cash value. So most individuals will have Universal Life Index if they want interest accrued and plan to take from the cash value. Variable life, a type of permanent life insurance policy with an investment component, contains cash value, which is invested in a number of sub-accounts available in the policy. Sub-accounts are similar to mutual funds, except they're only available within the variable life insurance policy, and there's up to 50. The payout amounts are determined by the performance of the securities, meaning the policy will pay out more when the market is up, and the policy will pay out less when the market is down. Variable also gives favorable tax treatment. So, what do you think most people have? Whole life, pretty consistent. Variable was popular in the 2000s. Term is getting steadier and steadier. So people are very into protecting their assets with term life, it looks like. Or it could be the cost, I don't know. So what are the top things life insurance is being used for? Number one is children. You know, we often forget that life can truly change in an instant. Before that instant happens, we need to talk about what would happen to your kids, your significant other, or the ones who rely on you and love you if your life would be shortened or come to an end. Imagine you pass away. There is now potentially only one income or no income, a lack of funds, or funds ran out because your current life insurance plan that's in place wasn't reevaluated. Your significant other or head of household will have to work more or go back to work, maybe even have multiple jobs. Your kids will not see their significant other and vice versa. You know, the kids will be robbed of the time of who they have left. Your kids will feel the financial ramifications. Kids are not supposed to feel financial ramifications. Kids are supposed to have fun. Feeling financial ramifications turns into struggling emotionally, and on top of not having your significant other or whoever is now the caretaker in the home. It's hard to imagine, but we have to go there. The childhood children are thinking how much better things were when you were around because there are struggles. Someone is not there for the childhood children because they are working. The childhood children are left feeling negative emotions because they're consumed with missing you and thoughts of what it would be like if you were still here. It's tougher. You know, life insurance preserves your legacy by preserving their life, and also provides immediate tax-free death benefit to protect against financial loss and hardship that they may experience. Another thing life insurance is being used for is retirement. Life insurance with cash value can help with supplemental income during retirement to maintain a standard of living. Cash value grows tax deferred, and distributions to supplement income can be received income tax free. But, let's say you become disabled during retirement or in general. You can add a waiver of premium rider when you first obtain your policy. A waiver of premium rider is a provision in the policy saying if you unexpectedly become disabled, which generally means an injury or illness has occurred which renders you totally disabled and unable to work, and you can no longer pay the policy premiums. The policy premiums can be waived. Insurance companies generally charge more for this rider, and the definition of totally disabled is not universal and can depend on the insurance company and policy. Having this rider will keep you from losing access to the cash within your policy in case of becoming disabled, not working, and able to pay your premiums at any point in your life. So that leads us to long-term care. What if you become in need of long-term care? To be able to utilize this rider, a medical professional will have to certify that the policyholder can't perform 2 activities of daily living or needs supervision due to a cognitive impairment such as Alzheimer's or dementia. You're then allowed to access a portion of the policy's death benefit to pay for care. It's important to remember, Medicare does not pay for long-term care, and the cost of care is expensive and rising yearly. Care now sits at $48,000 and $102,000 for a community or assisted living facility. Adding a rider to policy can sometimes be more affordable than a standalone long-term care policy, but it's important for a financial professional such as myself or Andrei to make that assessment based on your current situation. Extended care is an important necessity because it protects your assets from being eaten away by the rising high cost of care. It also prevents family feuds, which will last long after you're gone, because usually individuals in the family feel like someone didn't pull their weight to take care of you, or the financial obligations were not equally shared. Someone's life and lifestyle will have to change to take care of you. It also alleviates severe stress to a loved one from watching you slowly disappear while in their care. Not only are the financial burdens large, but the emotional ones are larger to the ones you leave behind. If you think it's possible you could live a long life, take a moment to think how severe the consequences would be to your significant other, children, loved ones, emotionally, physically, and financially if you need care over a period of years. Benefits from a long-term care rider are usually received income tax-free. So what else is life insurance being utilized for right now? Final expenses and estate planning. Death is expensive. The average funeral as of 2021 starts at about $3,000 and has no ceiling. If an estate is in place, it can take time before the money is released to your family. So take a moment to imagine which loved one will go into their personal bank account to take care of funeral costs, business debt, and estate taxes. Again, think about how this could leave that loved one feeling animosity towards other family members who may or may not have stepped up to the plate at that time. Funds from life insurance could immediately pay for these expenses tax-free. There's also policies called final expense policies just for covering these types of expenses. This is also something my office can help you look into further. Final expense policies protect and preserve life insurance funds from being used for anything but taking care of your loved ones you leave behind. Just ahead of Mark, we'll cover more of the in and outs of estate planning in a bit. Existing mortgage, debt liquidation, emergency fund. Think about the tremendous weight someone you love would have to carry if you were to pass away with an outstanding mortgage and debt. Not a good thought. If you have a mortgage or debt with someone, it does not let them out of their obligation to pay. If there's no coverage or there's no sufficient coverage in place, this may cause a displacement, financial hardship, and excessive emotional turmoil on top of mourning. Can you imagine the unexpected costs that have come up for you unexpectedly in the past couple of years, such as needing a new refrigerator, car maintenance, a costly traffic citation? Van Nuys Court got me on that one. Not a fun payment. The home needing the roof fixed or piping redone. There's just so many things that come up. Life insurance is also being used for business planning. If you have an existing business, life insurance can be used to protect that business from the death of a key employee whose knowledge and contribution to the business are invaluable. The loss of a key employee can cause business closure, loss of sales, brand value, and clients, ultimately. Insurance can provide to keep the business afloat until you find a replacement, used to provide the replacement salary or cover lost sales. It can also be used for business succession, can be used to provide executive benefit plans. This is something that Andrei can definitely go over or help you with more in depth. But last but not least, childcare and education. One of the biggest use for life insurance, we touched on this briefly in the beginning, is making sure your child and a child you love is taken care of. In the event your partner or head of household has to go back to work, having funds to cover childcare is essential. Depending on where you live, the average cost for childcare is $991 per month, which roughly comes out to $11,000 per year. Once the child hits 18, there's the daunting task of covering college, which, depending on where they end up going and inflation, not a pretty penny. Life insurance can cover college for the child or the children that you love, and it can also do it while you're alive with cash value. Strong financial plan, which Andrei Hall specializes in, can help with the cost of college as well. So that's something he can also help you out with. So, buying a home with life insurance. Can you guess what one of the most Googled terms is? I just gave you the hint. Buying a home with life insurance. Is it possible? Yes. The two strongest policies for this is going to be permanent life insurance policies. So the more premiums you pay on a permanent life insurance, the bigger the value grows. Universal life lets you put more money into it, which can cause a bigger cash value. You can access that value for a down payment or even purchasing the home flat out, depending on where you live. Personally, I live in California, and I won't be doing that anywhere here. If you're thinking about using life insurance as a down payment, mortgage lenders place high value on liquid assets when looking into your financial situation. Permanent life insurance means quick access to liquid cash. So maybe you already have a down payment. The cash value of a life insurance can assist with a bigger down payment, which can mean a lower interest rate and more affordable monthly payment. But don't forget, there are closing costs and moving costs when purchasing a home, which life insurance can assist you with as well. On this topic, however, it's important to consult with my office or a financial professional like Andrei Hall, who can make an illustration on how taking out this type of loan with your life insurance will impact your policy. There could be many repercussions financially, a loss of any death benefit to your life insurance beneficiaries, and even a loss of the policy. It's also important to make sure the company your policy is from allows this. But I just want to say, using your life insurance to buy a home can be a wonderful, life-changing experience. But once again, it's an absolute must to consult with Charlie Brown, my office, or Andrei Hall before doing this. So, the legacy. How will life insurance carry on my legacy? What is your legacy? Today we covered the different ways life insurance can protect assets. It can provide a level of normalcy of everyday living when you pass, relieve stress, emotional turmoil, and avoid family feuds and estrangement long after you're gone. Besides the money, the emotional and interpersonal relationship aspects that life insurance alleviates for your loved ones is a huge legacy to leave. Just imagine your kids, grandkids, significant other, or someone you love dearly remember the good times with you, but one day something happens and they actually stop. They stop to thank you for what you were able to provide them, the good life they are currently living, the peace of mind and financial security you have blessed them with. Life insurance is powerful. It's not a product. It's a part of the plan. And life insurance is for everyone. So, I'd love to connect with anyone who's here today, talk about the plan, or just stay in touch. Always feel free to email me at natasha@medicarerocks.com or call me. You can email me at natasha@medicarerocks.com, or you can call me at 714-477-0970. We're not here on this earth for a long time, but if we connect, I feel like we're making the most of the time that we are here. So now that I just talked a lot about how life insurance is intertwined with estate planning, I want to pass things over to Attorney Justin Hedemark of Hedemark Law, who's a part of my team of knowledge and is always here to help with a powerful estate plan. So, Justin, how are you?
Natasha, I'm doing great. Thank you so much for that wonderful share, and thank you, Charlie, for your lead. And I'm really excited to introduce Andrei after my presentation here. So today, what I'd like to talk about is estate planning and how you can use it to organize your entire plan, both now, in the future, and for generations to come. So before we get started, I just want to reiterate, this quote of St. Francis of Assisi, the only thing we have when we leave this earth, you can take nothing with you that you have received, only what you have given. A full heart enriched by honest service, love, sacrifice, and courage. And ultimately, that's true. But if you're watching this webinar right now, you have a different plan. You have people you love. You've been able to accumulate some sort of comfort and stability in your life, and you want to plan for those whom you love and perhaps purposes and charities that you wish to carry out, purposes that you yourself care about. So whether it's impact, whether it's family, whether it's your alma mater, as we saw with Stanford, there are steps you can take to preserve and protect your desires both now and in the future. But before we get into the details, what I'd like to do is highlight some of the things to avoid. And if you want to follow up with me, please feel free to check out my website or give me a call, 415-692-1503. I'd be happy to chat, and I'll put this up at the end of the presentation as well. So as it stands now, there are three main things that I want to highlight, which everybody is exposed to, regardless of their planning. The first is in California, the legislature has enacted a plan for you, even if you don't have one. It's called probate. So if you don't plan, you're planning to fail. And it's an old adage because there's a kernel of truth to it. If you do not set up a plan, then the legislature has enacted probate statutes, which dictate who is to inherit your assets, how they are to receive them, and essentially, it's a public court overseen process with high attorney's fees, high executor fees, and no restrictions on how those funds are to be used. So ultimately, at the end of the day, it will cost your estate quite a bit of money and time and scrutiny from the public at large. And the people who receive those funds will be free to do with it as they wish. So depending on your plan, if you want to have some say in it, then you should set up an estate plan ahead of time. The other one was alluded to by Charlie and Natasha, which is conflict. You know, we love our family, we love our friends, we love the people that we do for a reason. However, just because I say something one way, it doesn't mean it's received the same on the other end. So multiple people can have differing opinions after viewing the same circumstance happen. And more often than not, one family member believes they're entitled to more than the other for whatever reason, whether they went to Thanksgiving and the other sibling didn't, or whether one child feels the love and the other says, I was never appreciated, whatever it is. The intent in estate planning is to maximize and effectuate your intent, not somebody else's interpretation. So in order to avoid probate, avoid conflict, and create certainty, it's best to plan now and update it in the future as circumstances change. So moving forward, what can you do? I would suggest at the very base minimum, having an advanced healthcare directive, power of attorney, a will, and a trust. And if you're viewing this, most likely you already have at least one or maybe all of these already set up. Good for you. But when was the last time they were updated? So this is key as well. Life changes, our families grow, our assets increase, we purchase new properties. Maybe we invested in a company. Maybe we hold stock. Maybe we have equity in our employer's company. Or maybe we've invested our funds with Andrei and he's gotten great returns for us. And now we're looking at a big capital gain. What can we do? So moving forward, having an advanced directive is key. This allows you to designate somebody to make healthcare decisions for you if you're unable to do so yourself. The power of attorney is very similar. If you lack capacity, whether medically induced or if it's due to old age or physically, you designate somebody to be your legal representative. That means they could sign purchase agreements for you in the case of new property, or adjust your beneficiaries on your life insurance, if so is needed. And moving forward, this is all due when you're still alive. After you pass away, the advanced directive and power of attorney cease to be effective. Oftentimes, people will come to me and say, my mom had a power of attorney, she passed away, I should be able to do everything. Not the case. You have to have a testamentary document if somebody passes away. And that's where we talk about wills and trusts. As was alluded to earlier, probate is the legislature's idea of how your assets should be handled. And a will, by and of itself, does not necessarily avoid probate. It's a common misconception. The probate limit in California is only $166,000. And I say only not because that's a small amount of money, but in relation to real estate values, to the incomes earned in the state, they can be very high. and in other states. California is notoriously onerous when it comes to probate. So having a will is good, and it's a first step, but moving forward, you really need to have that will coupled with a trust to make sure that your intent is carried out. The trust is a key part of any estate plan because it's a legal entity that you can create, you can control, and you can manage. If you do pass away at some point in the future, then your successor trustee steps into the breach. And as Natasha pointed out, if your assets are held in trust, then you won't have to rely on a relative forking over money for burial expenses, for immediate costs, or as Charlie pointed out, if you have an investment property and property taxes are due, the successor trustee can access trust accounts immediately upon receiving a death certificate. And they can take over managing and controlling and preventing the loss of any income or loss or debts incurred by family members. So it really creates a smooth, streamlined process and transition period to avoid that pain and feeling of fear and regret that people go through when they can't step up and they can't take care of those things. Because let's not forget, we're dealing with death here. It's a reality, but it's an emotional impact as well. So the last thing I would want is for my family to be left in the lurch, essentially. So advanced directives, power of attorney, will, trust, these are all the basic building blocks of any comprehensive estate plan. And updating your beneficiary designations, retitling assets, and having a good, solid financial plan of how to take care of that, which is why we're here today. Moving forward, I'd like everybody just to take a quick snapshot of some key facts and figures. This year, the gift tax is set at $15,000. The federal estate tax is set at $11.7 million per individual. However, that amount is going to sunset in 2026. It was enacted as part of the 2017 Tax Cuts and Jobs Act, and we don't know what's going to happen. Headlines recently alluded to the fact that maybe it could be reduced. So estate planning has to be consistently updated. As I mentioned previously, just because you have a trust executed in 1995 or 2005 or 2015 doesn't mean it's effective and executing your wishes accurately today. So when you're setting up this estate plan, really need to know, can I change these documents? And if so, when? And how often shall I do it? Then you can come back to either me or another attorney to help you update those documents as your life changes. Some interesting figures are that the probate costs are set by an accelerating equation. So the more assets you leave, the more fees somebody like me would get from going to probate court, and your executor would get paid. You'll see in the bottom left on the screen just a brief calculation, some general figures. If you had $1 million estate, you're looking at close to $50,000 in fees right off the top. And then as you get higher, so do the fees. So why punish your generations subsequent by leaving an unfinished estate plan? Conversely, trust administration is routinely less expensive, although it does depend on the nature and the complexity of it. So moving forward, just think about that. And after you do set up a plan, you really should speak with your financial advisor, like Andrei, to understand how your returns may impact your taxes. Because if you leave money in a trust, it will be taxed at a higher rate than as an individual, most often. It always depends on your income, but it's very fact specific. Generally speaking, trusts do earn income and are taxed at a lower rate, higher percentage. So the more income you make, the more you'd have to pay. And that is why you need a team of diverse professionals covering all of the bases we described to accurately and professionally advise you. Some common vehicles people talk about in addition to the basics that I've outlined, in addition to the advanced directive, power of attorney, will, trust, we get into corporations, limited liability corporations, family trusts, dynasty trusts. If you want it to stay in multiple generations, you can do that. If you want each child to have their own trust, so that way they're not fighting over a big pot of money, but it's bifurcated or it's segmented into separate share trusts. It all depends on what is your goal? What are the family dynamics? And this is how I like to approach advising clients. Ultimately, this is your money. What do you want to do with it? Whose life do you want to change? What purpose and impact do you want to have after you're gone? Whether it's socially conscious causes, whether it's environmentally progressive issues, or whether it is a cultural aspect that you find necessary, like art, music, science, something I haven't named. Whatever it is personal to you. You should be able to dictate how your money and how your assets are used. And if you specifically focus on real estate, there's some really important things to consider, which is, who are you leaving it for? What purpose do you want to have for that piece of real estate? Do you want to leave it to the family to be used as a family home or a vacation house? Okay, that's great. Who's going to pay the property taxes? Who's going to pay the maintenance? Who's going to pay the upkeep? Where are you going to get the liquid funds? Is it going to be from a life insurance payout? And if so, is it a one-time payout? How is it going to be invested? Got to talk to Natasha, got to talk to Andrei. Or is it going to be income producing? Should it be in an LLC for liability protection? As Charlie mentioned, if you're going to take that money and you're going to put it into 3 investment properties, how are you going to protect the liability of your trust, your assets, and your beneficiaries? These are all really worthwhile conversations to start and things to just consider moving forward, especially when you're thinking about purchasing property, because sometimes, especially when it comes to property taxes, when and how you purchase property dictates how you can transfer that and what the property tax implication will be moving forward. Just to reiterate some of the real estate implications, the costs, the income, the liability, the equity, these are all hyper-local. So just using California as an example, each county has different rules, different regulations, especially when it comes to income-producing properties and rental properties. Because San Francisco, for instance, has some of the toughest tenant protections in the country. And if you're going to be a landlord, if you're going to get involved, absolutely you must talk to a landlord-tenant attorney. And this is usually where I advise my clients to go. So when you're talking about all of these different timelines, investments, liability protection, you want to make it as ironclad as possible. But just know that if you do leave this asset, you're exposing your trust and your beneficiaries and ultimately their generational wealth to potential claims. And finally, some property tax issues. I know if you're viewing this, you've probably read something about Prop 19 if you're located in California. So I just wanted to touch on it in a nutshell. It did change the exemption from property tax reassessment for property transferred from parents to children and grandparents to grandchildren. Gone are the days of the full exclusion being applied to primary residences and up to $1 million on an investment property. Now, unfortunately, under the current regime, after February 16th, we are living in Proposition 19 world, and it has limited the exemption on property tax reassessment to only $1 million of fair market value on the primary residence, and that's it. No investment properties, nothing in addition, and it's pretty limited, only if the child then moves into that primary residence. So that may impact whether you want to leave property or multiple pieces of property to children or grandchildren, because with a reassessment, the carrying costs are going to be significant. We have to talk to Natasha and Andrei to find out, is your trust going to have enough liquid assets and income to weather that reassessment? If it's going to be an income producing property, is it going to cover the maintenance? Is it going to cover the insurance? Is it going to cover the property management fees? So who's going to be overseeing that? It really matters as far as what's your overall purpose, what's your overall goal, and who do you want to protect and provide for. Very interestingly, to Charlie's point about purchasing property and reinvesting, one cool thing that Proposition 19 did was it allows property owners to transfer the base year tax value of their property up to 3 times if they qualify. So key considerations in a nutshell: 55 and over, if you're severely disabled or a victim of wildfire or natural disaster. Now you can transfer your base year tax value for property taxes to your next home in any county in California. So that's one positive note from Proposition 19, but at the cost of parent to child and grandparent to grandchild exclusions, one could argue it's a difference with a higher cost. So these are just some things to consider, again, to properly plan for your circumstances. Every estate plan is different. It's got to include an eye towards real property as a hedge towards inflation. It's got to have insurance to provide for unforeseen costs and liquidity events. And it's got to have a financial component in terms that Andrei will describe briefly in my next segment. And he's going to describe exactly what you need to do to invest, to diversify, to keep an eye out on the markets. And if you have any questions, please contact me. My contact information is on the screen, and I look forward to speaking with you in the near future. And with that, I'll turn it back over to Natasha to introduce Andrei, and thank you for letting me share.
Thank you, Justin.
That was, as always, incredible. We have the great Andrei Hall, president of Hall Wealth Management. How are you?
I'm doing great.
Good.
Myself.
Pretty good.
I'm going to let you take it away.
Okay. Well, hey, folks, I'm not going to talk long because I know we've all been Zoomed to death during the pandemic. So I'm just going to go through a few slides and we're going to go from there. So the first slide, hold on a second. Okay. Basically, you can see there, my name is Andrei Hall, president of Hall Wealth Management Group in Irvine, California. The one thing that people fail to realize, and Justin said it somewhere towards the beginning of this presentation, is failure to plan. And if failure to plan is planning to fail. And so that was something that I learned in my first management class when I was in the corporate world. And so many people talk about planning, but they don't put all the processes in place to follow through on that planning. And one of the things when we're talking about financial planning and holistic planning is we have to truly understand what's important to the person or the family. Identify and select those goals. We gotta really, and it's easy to say, everyone says, I don't wanna run out of money, okay? Everyone says that I wanna travel in retirement. But again, we gotta get much deeper than that. We gotta really truly understand what are the things that are most important. We really wanna understand and analyze where you are now, because that's the base. Okay, we got to understand your base and where we're going from there. We got to understand how to develop the right kind of financial planning recommendations. When I was in the corporate world, we used to bring in the biggest consultants in the world. I was with a Fortune 500 company as a vice president and a corporate officer and at another company. When you bring in the biggest consultants in the world, they give you all of these things, and it's a thick, a long presentation with a book on all the recommendations, et cetera, things you're supposed to implement. But guess what? They walk away after that. And it's up to the company, and 90% of those studies never get implemented in Fortune 500 companies, but they get paid for it. And that's the thing that you don't want to happen when it comes to financial planning. You really got to implement, and it's not optional. It says optional, but you got to implement that financial planning recommendations with the advisor, with someone like myself. You got to monitor and constantly update those plans because things change, tax laws change. A lot of different things change and circumstances change between divorce, marriages, grandkids, etc. It is a collaborative process. It really is. It is without really working together. And if you and the advisor are not on the same wavelength, you're not going to get to where you need to get to. You gotta know what your destination is. The destination is really all about understanding, identifying, analyzing, recommend, present, implementation, and monitor. But if you don't do all of those steps, if you leave one or two out of there, you're not going to get to that destination. Now, We all hear a lot about holistic and comprehensive financial planning. When you look at financial planning, it's really all about managing the money, achieving the goals, etc. Holistic planning is all about those other things, getting to another personal level when it comes to peace of mind and fulfillment. And you can see there on the side those different things. It really boils down to a lot of times, a lot of people have a lot of money. We've seen Bezos and we've seen Bill Gates here, both of them getting divorces, got billions. We've seen Warren Buffett. They all had issues with their spouses, even though they each had about as much money as anyone could ever dream of having. So when it comes to peace of mind and fulfillment, they obviously weren't all the way there. That's very important, and that's what we have to constantly look at and come to grips with. And that's part of what I work with my clients. I'm not saying I'm not a therapist or anything, but at the same time, we have those deep discussions as to really where they are and where they want to get to overall, just not in the financial planning part. Common objectives: too much work, too expensive, too late. I can do it myself. Well, first of all, we minimize the work, but there is some work and things you got to help with. Too expensive. It's easy in the sense that when we're talking about what the charges are, not just for myself, but any financial advisor, if they're doing the right kind of job for you, they are giving back 10, 20, 30, 40, 100-fold. So it is not ever too expensive if you're working with the right person. Is it too late? It's never too late to start planning. Who is that? The guy from McDonald's and Colonel Sanders, they were in their 60s when they started those things, okay? So it's never too late to start. Can do it myself. We've already talked about people that want to try and do it all themselves. There are free online tools, but they're generic, one size fits all. One of the things that I'm going to do as working with my clients, I'm going to make sure everything is in place. The things that Justin talked about, the things that Charlie talked about. I don't do it all. I don't know everything, but I know how to bring the right people together to enable us to come up with what it is that meets your needs and objectives. What Dwight Eisenhower said, plans are worthless, but planning is indispensable. And I just add to that, and the implementation of that planning is also indispensable. Thanks a lot, appreciate it. Natasha, I'm gonna turn it back over to you.
Well,
thank you, Andrei. Appreciate you being here today. Justin, Charlie. Well, it was great. I'm very happy to have you as a part of my team of knowledge. Like Andrei said, I don't know it all, but I'm pretty good at connecting people that can know it all. So thanks everybody for attending today. You'll be receiving an email shortly with all of our contact information. And always feel free to reach out. We're here to help you, and we're here to make you a success as well. So thank you so much.
Thank you, everyone.
Adios.
Thank you.